Distressed debt isn't really new. It started getting traction back in the 80s during the high-yield bond boom led by financier Michael Milken. A lot of companies took on debt, and many of them eventually ran into trouble. By the early 90s, investors began eyeing distressed securities. Investors saw it as a way to buy low, wait for recovery, and cash in. So how does it work? Distressed debt investing is basically buying the debt of companies in trouble, companies that might be perhaps close to default or even bankruptcy. Funds buy that debt cheaply from banks or other funds that don't want to deal with the situation, betting that they can profit from a turnaround, a restructuring, or even by gaining control of the company's future. Interest in distressed debt skyrocketed during the 2008 global financial crisis. Credit funds and private equity firms, including big names like Oaktree, Apollo, Ares, and Blackstone, seized the opportunity. Flash forward to 2020. The pandemic brought a halt to the economy, then high inflation, and lastly, rising rates. Many investors thought these events would trigger a wave of defaults and a flood of distressed debt. But that big wave never came. In other words, no recession, no spike in bad loans, no real distress cycle. Still, distressed debt investing continues to evolve, with new opportunities emerging every time the economy shifts, even slightly.